Hello, and thank you very much for joining our webinar today, which is sponsored by the Access Forum and the European Banking Institute. My name is Anastasia Papas, and I'm the director of the forum. It's a great pleasure for me to welcome today Mika Morse and Agnieszka Smoleńska, who will discuss the growing divide in climate disclosure regulations for banks between the US and the EU. We will start with Mika, who will talk about why banks are stepping back from their climate commitment in the US. So Mika recently served as the lead policy advisor on climate risk and finance for Chair Gensler at the Securities and Exchange Commission. So very well qualified to talk about our subject today. Immediately before joining the SEC, Mika served as a senior counsel and deputy legislative director for US Senator Brian Schatz. And in this role, she was responsible for developing and implementing the senator's legislative priorities on the Banking Committee, Commerce Committee, and Appropriations Committee. Previously, she was an international trade associate at Sidney Austin, a law firm in Washington, D.C. She received her JD from Yale Law School and her BA from Harvard College. Currently, she provides strategic consulting on climate finance and financial regulation policy as the CEO and founder of Goldfinch Strategies, LLC. I would like to note that we, both Mika and Agnieszka, will answer your questions at the end of both our presentations. So please make sure you write your questions using the Q&A function. So Mika, the floor is yours.
Thank you so much. Thanks so much for having me. Give me just 1 second. I'm going to share my screen to go through a couple of slides. Okay, I believe you should be able to see it now. So I want to talk a little bit today about why we see US banks stepping back from their climate commitments and what it means for financial regulation. So we've seen a lot of big tests in 2025. As you all know, the political environment has changed considerably in the United States. When I was working at the Securities and Exchange Commission, we had a lot of focus from every financial regulator on managing climate risk. But unfortunately, that work has been on pause with the new administration. And the public company climate disclosure rule that we finalized while I was working at the SEC is on pause officially and is being challenged in court. I won't go so far as to say it's dead because it's not actually quite dead yet, but I won't get into the procedure of that. But if you're curious, I'm happy to explain it. But in the US, what we saw actually starting in 2024 and then ramping up in 2025 were antitrust attacks at the state and federal level that really threatened banks and large asset managers based on their affiliation with net zero alliances. The argument there was that they were using these collective gatherings as a way of pressuring financial institutions to stop funding oil and gas, and were therefore in an anti-competitive way trying to control coal markets, for example. We also have seen an incredible politicization of climate and clean energy. This is most evident right now where we have a big knockdown drag out fight about Inflation Reduction Act. That's the sort of bizarrely named bill that created a suite of very impactful clean energy tax credits, among other things. And even though much of that money is flowing into states that are represented by Republican policymakers, those same Republican policymakers are united in trying to strip those out of law, which would set back clean energy investment. At the same time, we have an incredible surge in energy demand, as I'm sure people are seeing in jurisdictions all over the world, largely driven by AI, as well as domestic onshoring of manufacturing. And so what this has done is it's weakened net zero alliances. And we've already seen some rather high profile examples of banks retreating on their net zero commitments and sustainable finance commitments. And we've also seen some stumbles and legal challenges around mandatory climate disclosures, the very thing that was supposed to provide the information to enable markets to better price in climate risk. So I wanted to get at what was behind this retreat on net zero. And some of this came from the conversations that banks had with me when I was at the SEC and that they put into their public comment letters. So some of this is sort of interwoven in the public file. But basically, banks' climate commitments were hinged on a very fat set of assumptions about economy-wide decarbonization. What they were essentially saying is they were going to decarbonize because the whole economy would. And while they did have plans around the edges to support clients in their decarbonization journey and provide other products and services that they could monetize to help companies on that journey, they were not at all prepared to stop financing high-emitting sectors, particularly when we saw the rise of legal and political risks in the US for making that type of choice. And so what's interesting about that is that it really has obscured what exactly banks considered necessary for a deep transition and what their actual transition activities are or will be in the future. I have no doubt that even, the sort of most quick to retreat banks in the United States are still planning on carrying out transition activities because there's a strong strategic opportunity there. And I do think that they are trying to grapple with the risks of not acting, but we have very little information about what that actually looks like. So we have fragmented disclosures. They're not particularly reliable. And even when we do get disclosures, so much of it is narrative, very general, and very little of it quantifiable or related to financial metrics at all. And so we don't really have, the kinds of information around capital expenditures, energy finance ratios, or other KPIs that might tell us what exactly banks are doing and how then they are thinking about the risks that they might face of a more rapid or disorderly transition, or what kinds of strategic opportunities they've identified. And so the consequence from the perspective of a financial regulator is that you do have this potential for a buildup of transition risk in the system that we know less and less about. So I think that there is a huge challenge today of implementing net zero commitments. And some of this is just a realization that banks sat within the economy. And whether this is completely accurate or not, if you ask them, they will often say they are not responsible for steering industrial policy and they cannot make the economy. So if there are not enough bankable opportunities in clean energy or in deep decarbonization, they can't bank them. And I think that that's true, but I also think that we haven't done enough thinking about how you unlock capital for some of those significant climate solutions that are really sort of the gateway to deep decarbonization. So I think the international climate groups are starting to see their role and potential opportunities in this space. And you see them beginning to recognize just how challenging some of the ambitious commitments will be in real world implementation, and a growing focus on how do you unlock capital for climate solutions. And disclosures will improve. So even though in the United States, federal disclosures are on ice, and I don't think will come into effect for a very long time, if at all, we do have disclosure moving ahead in California, which is such a large economy, and their disclosure laws have such reach that it is almost equivalent, really, to a federal standard, and actually goes beyond just publicly traded companies. So it'll be really interesting to monitor that space. The litigation that's pending on that, I think people largely think that California has a fairly good chance of fending off those challenges. And then obviously we're seeing broad adoption of ISSB. And even though we've seen CSRD confronting some challenges around the sort of scope and breadth of disclosure metrics, I think everyone largely expects that will continue to go into effect and will cover more and more entities as time goes on. We're also seeing interest from investors in pushing for these transition-specific metrics for banks, like the energy supply finance ratio. And I think that that'll be an interesting space to watch, because I think that starts to put real money behind, okay, you've made this commitment, well, what is that really looking like in what you did this year and next year? And you can kind of compare over time. And so these dynamics are going to make it possible for us to think in a little bit more of a sector-based approach and begin to get into the weeds of how do you actually implement some of these commitments, at least for those banks that are willing to engage on that. I mean, I think, the underlying issue here in the United States is that there's considerable political risk, which is translating into heightened legal risk for even engaging on these issues. So I have thoughts on how, we should be thinking about managing transition risks at this point in time. And I actually want to spend the most amount of time on thinking about what the recommendations are for policymakers. I think that the recommendations for banks and investors, aren't particularly surprising, which is that there's a real obligation to be more transparent about transition finance activities and ways of thinking about communicating to investors and other stakeholders exactly what those challenges are. I would actually like to see the paradigm of basing commitments on sort of unspoken assumptions flipped, and to have banks and their sustainability reports engage much more with the kinds of assumptions that they're making and what are the conditions precedent they need in order to accomplish their objectives. Because I think that would be very illuminating for policymakers to see where exactly they need to act in order to bring the economy along on its decarbonization journey, as well as maybe even attract capital from private equity and venture capital into interesting innovations that can tackle some of those bottlenecks in different industries. And for investors, I do think that, going beyond the sort of narrative and looking for more financial metrics to back up sustainability claims is incredibly important. When we worked on the SEC public company climate disclosure rule, one aspect that I thought was going to be particularly impactful were changes to actual financial statement disclosures. So one of the things that was somewhat innovative about the SEC's rule was a requirement that companies disclose costs and expenditures from severe weather events and natural disasters from the previous year, something that companies are definitely tracking but don't always disclose, and a requirement to disclose that both on a gross basis and then net of insurance proceeds as a way of giving investors an understanding of how reliant companies are on insurance and what might happen if that insurance became much less affordable or much less available. And so for policymakers, I mean, I think obviously continuing to drive towards better, more reliable disclosures is really paramount, because that's how we understand what's happening. And for those that are prudential supervisors or thinking about systemic financial risks, these are important inputs. And rather than just thinking of them too as regulatory disclosures only for the regulators, it's important it's available to the whole market, because that will drive better pricing of those risks in the market. I also think there's a lot of work underway around the development of credible transition plans and what that means for transition finance. And what I mean by that is more of a roadmap of how exactly you get from here to a successful, thriving business, or in the case of a bank, thriving financial institution in a low carbon economy and against the backdrop of increasing physical risks. And what are the transition finance products and services that will get us there? There will obviously be systemic obstacles to decarbonization, and those are going to absolutely require policy change. And if we're not really clear about that, and we just assume that the private sector is going to be able to carry this forward on its own, we'll never reach the finish line. It is the case that, you don't necessarily expect, or could think that, an individual bank can drive energy policy, any energy industrial policy forward on its own. I think it's also important to continue to integrate climate risk management into prudential and systemic risk supervision. I absolutely think that climate risk is likely to be one of the next big drivers of a systemic financial meltdown, because of the fact that it has, in so many ways, created unrecognized losses. And I think that, and I'll talk about a little bit more about this, I think that it could materialize relatively quickly and in ways that are fairly unexpected. So on that point, I was at the SEC when Silicon Valley Bank collapsed and caused systemic destabilization amongst the so-called super regional banks. So these were banks with between 50 billion and 250 billion in assets. And what was really interesting about this as sort of a case study of what might trigger a climate-driven financial crisis was that this whole crisis was based on interest rate risk, something that is incredibly well understood, very well known, totally disclosed. All of the information you need to understand the risk sitting on Silicon Valley Bank's balance sheets would have been readily available to investors, and clearly they were to supervisors. The problem is that as supervisors were trying to get their arms around managing it, many of the actions that they could have taken to more aggressively get Silicon Valley Bank to deal with it, I think could have triggered the collapse, on its own. But what you ended up happening is, no, it wasn't like the day that the Federal Reserve increased rates again, or it wasn't some massive exogenous event that happened. It was that you had 4 consecutive quarters of this bank losing deposits. On March 8th, the bank announces a plan to raise capital. On March 9th, investors rapidly changed their perception of the bank's risk, and by March 10th, it had collapsed. And so what this shows is that investors' risk perceptions can change very quickly and not necessarily triggered by something so significant. And for those that are in prudential supervision and focus on systemic risk, I think what this means is we can spend a lot of time thinking about what huge hurricane or what combination of hurricanes, fires, and floods could lead to a repricing, or what sort of policy change would trigger a massive repricing of assets. But we will never be able to predict what it is. And so instead, I think one thing that we need to start doing is thinking about what are new correlations between different kinds of assets and their risks that create concentrations that are hiding in plain sight. And there may be things that are much more related when you're considering, a repricing along a climate risk, category that we have not grouped together as related. And so that, I think, bears a lot of thinking, because many of our traditional tools of thinking about liquidity and concentrations and other risk stripes are going to be applicable in a climate-driven financial crisis as well. That said, I think when anyone talks, and when I was working with the Financial Stability Oversight Council on the monitoring of climate risks in the US system, there was broad agreement that insurance is likely to be the leading edge of a crisis related to physical risks. And one of the things that is troubling is that when we do a lot of our scenario analyses and we do stress testing and we sort of think about where to apply the most, intensive climate risk management policies, we've been focusing a lot on the largest, most systemic banks. And that makes sense, because those were the loci of systemic risk in the past. But I actually think it's the smaller and mid-sized financial institutions that are much more vulnerable and much more likely to create a crisis, because they are more concentrated geographically, they're more concentrated in terms of industry, they're less sophisticated in terms of their data use and modeling and their risk management procedures. And we just don't impose as many obligations on them because politically, they're just better able to communicate that they need a lighter touch regulatory regime. And in fact, what we saw in the wake of the Silicon Valley Bank collapse was that it was the banks that they had gone from a higher tier of regulatory oversight in the United States pre-2017 to a lighter touch regime after a law change in 2017, And it was those that investors were most worried about and most likely to flee in times of turmoil. There's also been a lot of observations that AI and social media can significantly accelerate contagion. And so things can just happen much more quickly than ever before. And the other thing that has been observed is that financial institutions have been and will continue to transfer much of the risk to the public sector. In the United States, that's in the form of moving a lot of mortgages onto our sort of quasi-governmental agencies, Freddie Mac and Fannie Mae, but also in the form of state insurers of last resort, as well as our federal and state natural disaster response programs. And so this may not necessarily mean that we'll have, as terrible of a financial crisis as we would otherwise have, but it will certainly put pressure on governments and could create fiscal crises and undoubtedly will cause harm to households. And the question for some of the larger banks is how much of the fiscal crisis and the harm to households will then double back and actually create further headwinds for the financial system as well. So it's all in a loop. So one thing to think about, in this sort of diverging approaches potentially between the US and the EU and sort of, how much climate risk is in the focus is that you will have a buildup of both physical and transition risks in the United States, less information about it, and much less willingness from financial regulators to manage it. And that can have some spillover effects given the global nature of many of our institutions. So anyway, not the most optimistic picture, but I think something that we will really need to, find allies in working on, even as our federal government is taking a major step back from thinking about climate financial risk in our financial system. And then that's it. Thank you. I'm going to stop sharing now.
That was a very interesting presentation. Thank you very much, Mika. And now I'm going to pass the floor to Agnieszka. Agnieszka is Senior Policy Fellow at the Center for Economic Transition Expertise at LSE. And she's leading the work on transition planning in the financial sector. She joined the Gratham Research Institute on Climate Change and the Environment as a visiting fellow in 2023. She holds a PhD in law from the European University Institute, where she has been part-time assistant professor with the Florence School of Banking and Finance. For the past 15 years, Agnieszka has worked as an academic, policy advisor, and journalist with a view to improving policy making in the area of economic regulation. Her research interests span banking law, sustainability, transition, and euro area governance. So Agnieszka, the floor is yours, and hopefully you can give us the lay of the land in Europe.
Thank you very much for the kind introduction, and thank you also already to Mika for a very interesting presentation that showed us the state of the discussion in the US context in particular. And this is definitely one of the areas where we see quite some divergence. So over the next 10 minutes or so, I'm mindful to make sure that we have enough time to discuss. I will give the participants a little bit of an overview of where we are in the EU and what has been the approach to date, also diving in a little bit into some of the work that we've been doing recently at CETEx and at Grantham on climate change litigation related risks and how banks in the EU are dealing or not with this particular phenomenon. So whereas in the different jurisdictions have taken quite a different approach to integrating and managing climate change related risks into the prudential framework, in the EU, we have seen, especially since 2018, 2019, 2020, an approach that has emerged that has been defined by its comprehensiveness when it comes to sustainable finance. So we really had a multi-pronged push to advance sustainable finance agenda, both on the side of regulation of financial products like green bonds, increasingly also ESG ratings, new types of services, as well as on the side of investor protection. So we had inclusion of sustainability preferences in the MiFID framework as well. But a bulk of the work has happened in the prudential regulatory space. So specifically the Capital Requirements Directive and Capital Requirements Regulation, which implement in the EU context the Basel rulebook. Since 2019 especially, and this has been the first really step towards integrating sustainability risks in the EU framework, we have mandatory Pillar 3 disclosures. I will come back to them in a little bit of a detail in a while, but that cover both the physical and transition-related aspects relating to banks' risk management, as well as elements of the sustainable financing that banks provide. So the financing that is that is taxonomy aligned. Last year, with the 2024 reform of the CRR and the CRD, in addition to this expanded scope of bank risk-related disclosures, we also have the expansion of governance requirements related to the type of how banks should be integrating ESG risks at the level of strategy, at the level of risk committees, at the level of remuneration and setting of risk appetite. We have new dedicated tools that have been incorporated into the EU's prudential framework, namely the transition planning requirement, or more precisely, the obligation to include transition planning and long-term transition risk assessment as part of banks' internal governance, new requirements relating to climate change stress testing. And to complement all of these requirements imposed on financial institutions, we likewise have new supervisory powers where supervisors are now obliged to integrate in their supervisory processes the assessment of how banks mitigate and manage climate change related risks. So a very much a comprehensive approach. There is a clear reason why banks are at the heart, why this concern with risk management is so important. Namely, banks have this central position in the economy, connecting clients, policymakers, investors, and the different also aspects of regulation. So especially the bank sustainability risk management, including transition planning, relies on real economy disclosures. And this is something to come back into the discussion. So in the EU, we currently have this big discussion around the omnibus reform, which limits somewhat the expected scope of disclosures from the real economy, medium and smaller size firms especially. That could make some of the requirements that have been imposed on banks already a little bit more cumbersome. And this was especially emphasized by the European Central Bank in its recent opinion on the omnibus package. Already, the regulatory framework requires banks to disclose certain information as to their physical and transition risk exposures, as I mentioned, and evidently this type of disclosures rely on banks' ability to have this data from their clients and the real economy. However, even if this sustainability disclosures from the real economy become constrained, evidently the risks will not go away. That is, the physical and transition risk concerns remain very much the foundation of EU's approach. And consequently, the limited availability of public data reported from companies will absolutely not absolve banks of prudential requirements. So we must also be mindful of the extent to which this limiting of publicly available disclosures will change the nature of risk management. So perhaps this is more about privatizing some of the data availability and increased reliance on proxy data. So kind of the impact will actually not necessarily reduce or simplify as the policymakers are claiming that the omnibus will do. And the reason for this is several-fold. So just to show you a little bit the state of first bank disclosures in the EU, already since the last few years, we have physical and transition and taxonomy aligned disclosures of banks. These are absolutely not the kind of perfectly robust. There is quite a lot of problems with regard to the quality of the data and its scope. But, and this speaks really to what Mika was mentioning as well, a lot of this data is not necessarily about, precision and risk management, but also seeing what are the new types of correlations between risks that are emerging, what is the geographical and sectoral distribution of these risks. So here we have, on the basis of the existing disclosures from banks in the EU, the European Banking Authority, responsible for coordinating and in setting some of the rules in the EU space, is already publishing this common ESG data here relating to physical risks. Moreover, the EBA work also points to the fact that already a majority of banks in the EU have in place quite some processes to identify data sources and use them in the risk assessments. Now, what we've done recently, just to give you a snapshot of how these sustainability disclosures of banks are revealing of the state of climate change risk management in banks. In a recent project with some colleagues from Grantham, we have looked into how banks across their disclosures, both in sustainability reports, but also in their Pillar 3 reports, deal with the growing phenomenon of climate change risk litigation, something that has been happening in the EU and has been also recognized as material by the Network for Greening the Financial System. We also know that under the Basel requirements, banks are specifically required to implement adequate provisions for risks that may arise out of legal actions. Now, looking at in the case of this forthcoming report, we looked at 20 different banks' disclosures just to get the sense of the lay of the land. And very importantly, and this is something that is also shows this changing nature of disclosures relating to ESG risk management, where precisely because of certain concerns about not being too prescriptive, regulators and policymakers in the EU especially have decided to first take the sequential approach, first requiring data disclosure in 2019 before in 2024 introducing more mandatory rules relating to ESG risk management. What we find in this report are a number of observations that can be potentially more generalized relating to banks' risk management. So we definitely see in the reports quite a lot of detail on how banks identify risks, how they really develop a more of a robust approach to understanding the transmission channels between climate change related litigation in this case and traditional risk categories, operational and credit risk especially, but where banks are really falling short is the risk mitigation side, both on the side of limiting ex ante the risks that they are exposed to by reducing cases of opportunities for litigation maybe, but also on the side of exposed ways to address risks. Two further observations that are key from this report are first that banks continue to underestimate physical risk. So on the example of climate change litigation, banks tend to focus on the transition risk side, underestimating, and this is again comes back to something that Mika mentioned, the risks that may arise in the context of physical risks materializing. And likewise, they underestimate the growing trend related to cases related to mismanagement of the transition, especially. Now, in terms of the recommendations that we put forward in the report, it's definitely not that to limit disclosures, but rather that this exercise really shows first the relevance of existing bank disclosures of ESG risks, either as part of mandatory or voluntary frameworks for prudential supervisors to understand the type of risks that banks continue to be exposed to, and also get this additional contextual information on risk management. We also recommend using transition planning as a forward-looking technique to address some of these risks. And I stop here in the interest of our discussion. Thank you very much.
Thank you, Agnieszka. That was another very interesting presentation. So there is a lot of food for thought. And I invite the audience to write their question on the Q&A function. I have one comment to make, which I thought was very interesting, and something that Mika mentioned, that the weak link, at least in the US, it's going to be the insurance sector. And as an economist, I just started seeing research on how different insurance companies are going to deal with physical risks related to climate. So there's a long way to go, but at least, it's encouraging that, at least academics are appreciating the risk and working on it. One question for Mika. You said that the crisis could be triggered by a rapid repricing of risk by investors. This has been sort of the criticism of the bank stress tests, in the sense that, bank stress tests assume this scenario that is slow evolving and, does not assume an abrupt repricing of risk. So the issue has been sort of the type of scenarios. I was wondering whether you could comment a little bit on this, because it's been...
Yeah, sorry, I didn't mean to interrupt. I'm just totally agree with you. This was such an interesting discussion amongst financial regulators over the last 4 years. And I think some of the things we're seeing come out. So we saw the Network for Grading the Financial System come out with short-term scenarios that I think were meant to try to capture a little bit more of fast-moving challenges that could happen. You have, I think, some large financial institutions are internally experimenting with reverse stress testing. So what would it take to cause a really significant repricing or destabilization? And that might reveal some of those hidden correlations and concentrations that we're maybe not appreciating. I also think that the general sort of normal stress test model, as I understand it, that the Federal Reserve carries out on the financial system, is really around a short-term shock, and then looks at 9 quarters of how banks perform following that shock. And that might not be a bad way. So sort of thinking about climate risk differently, instead of looking at, I think it's still really important to look at the sort of longer term evolution of these different risks, but maybe it's, what happens if you have a repricing for whatever reason? So rather than try to figure out what could cause that repricing, just assume that investors may wake up and bring forward these risks from, in 50 years in the future, how does that cascade through different portfolios? And then to, in particular, take that down to the sort of mid-size and smaller banks, because the large banks are quite diversified and are not holding on to many assets that might be risky, but have rather made money in other ways and then gotten rid of the risk. But somebody is holding that then. And it could be a non-bank financial institution. And there's absolutely a risk that non-bank financial institutions could be a source of systemic stress, or it could be smaller institutions, or again, it may have been transferred to the public sector. And that's something that, I think from a policy perspective, I believe it should be within the ambit of the financial regulators to say it's not an acceptable prudential solution to transfer risk to the public sector. Like if that's how you're accomplishing your risk management, that's not going to work. But I don't know, I mean, at least in the US, that has not been part of the conversation. And I think it will need to be by necessity, because we will be seeing such outflows from the public sector that it will become untenable.
Agnieszka, thank you, Mika. Would you like to add something to?
No,
No?
let's
Okay.
move.
So we have a question. Where are you seeing Canadian and Asian Australian regulators aligning on the spectrum between the US and EU? So I assume that's for both of you. Who would like to answer first?
Yeah, Agnieszka, do you want to go first?
Yeah, I'm happy to. Thank you for the question. I mean, this is clearly I mean, you can also add the UK to this, right? So we focus on the EU, US, but also in the UK currently we have the Bank of England having just released a new consultation on how the PRA is going to refine its already existing approach relating to integrating climate change considerations in how how it assesses banks and insurers here in the UK. I think we definitely see quite a lot of variance globally when it comes to these topics, but definitely some of the Asian regulators, also Australia, New Zealand. New Zealand has a dedicated bank transition planning requirement, also that it is implementing. Some of the Asian supervisors were also consulting over the recent years on refining their approaches, introducing dedicated prudential transition planning requirements. So there is a lot of variance, with the EU absolutely not being the most, I mean, in some ways, because of the complexity of the sustainable finance framework, it is perhaps the most has introduced the most type of requirements, but absolutely not at the forefront. We should also not forget that the integration of environmental risks, for example, dates back to early 2000s, where the Central Bank of Brazil has introduced environmental risk assessments in its ICAP requirements, right? So this is also something that is really building up over 25 years, and a number of jurisdictions, especially those for whom physical risks are already material, are definitely concerned with this aspect as well. Whereas we in the EU also see a lot of emphasis on transition risk.
Mika?
Yeah, I agree. I mean, I think that you're seeing a lot more focus on this in different jurisdictions, although some variation in approach. One of the things that we grappled with in our international engagement when I was at the SEC was just around the sort of definition of what is material. And I think that there are sort of there's some kind of natural division between the jurisdictions that are quite focused on financial or singular materiality, and then those that are like the EU that are more focused on double materiality. And I think that there's one lens in which those two converge, because as I understand it, that the idea of the double materiality is that these are things that can manifest down the line as risks, either from changes in regulation or a loss of the social license to operate. And so I think that there are very real financial ramifications too of other stakeholder impacts. But just in my conversations with, Canadian or some of the Asian regulators, this is one area where people are grappling with how do you kind of encompass the sort of widest range of risks, but also sort of continue to speak in a language that relates to financial materiality.
Great, thank you both.
If I could just add on this, because I think this is such an important point on the time horizon of prudential regulation, which I think is one of the main changes, because we can think also about the integration of sustainability concerns in prudential regulation as kind of expanding the lens of what regulators are concerned with, in terms of maybe connecting some of the physical aspects of our environment with what is financially material. And here maybe also the line in the past was a little bit arbitrarily drawn to exclude certain already material topics. But another is the question of extension of time horizon, which in the EU now is extended to 10 years in prudential assessments. So in the 10-year horizon, also the distinction between single and double materiality, which has really dominated the discussion, a little bit collapses also. So this is also something to maybe bring into the discussion and consider.
Very interesting, thank you. Another question from the audience is, how would you respond to the claim by the financial banking insurance lobby that climate is a driver of traditional risks rather than a new type of risk, and as such, it should not be elevated above other risks in supervision or prudential regulation?
I guess I don't necessarily, disagree that it's a driver of other risks. I think that is actually a helpful way to think about how it can manifest and how some of the tools that we've already honed over decades can be useful in managing climate risk. I think one of the reasons for elevating it is just that there can be these new correlations and new concentrations that we haven't been paying attention to that now require more thought. And I think when you're sort of, and we've sort of bundled together transition and physical risks as because they're climate driven, but those are both even quite different sets of risks. And I think you have people who really specialize in focusing entirely on one or entirely on the other. So I don't necessarily see it as elevating climate risk above other risks. I see it as needing to make sure that something that has been somewhat hidden and hard to detect because of different features where, up until now, I mean, it has manifested over a longer time horizon. I think some of that's not true anymore when it comes to the physical risks. And because it sort of encompasses a broad range of market responses that we've sort of clustered together that we may have thought of individually and in isolation and not seen the connections between them. So I think there's a usefulness in labeling them as such, as climate driven, and paying attention to them. But I don't think that they operate, significantly differently from some of these other forms of risk.
Thank you, Mika. One question sort of about the insurance sector, and I think that goes, another question for Mika is, are regulators covering the insurance sector, and are they paying attention to the risks you have cited?
Yeah, so in the United States, it's incredibly complicated. Insurance is not regulated at all at the federal level. So it's regulated state by state. That means you have, 50 plus others, if you include the territories, approaches to regulating insurance. And in a way that's been useful because the physical risks that each state faces are slightly different. The insurance contexts are different. But it does also mean that you have quite a patchwork of responses. What I heard over the course of, conversations at the SEC, and then since I have left, is that insurers' business models are under a great deal of stress. They are having a very hard time remaining profitable at the premium levels that they can charge against the claims that they've been required to pay out and the skyrocketing costs of their reinsurance. I think they have a double whammy that they are not paying attention to, which is also that they will have asset impacts and, may find it challenging to generate returns on certain assets that they're holding that are subject to physical risks and transition risk, candidly. They're fairly nimble in the sense that they have the option every year to withdraw from risky markets or attempt to raise premiums. And they can also choose not to underwrite certain risks. And for now, their answer is, well, we'll kind of continue to do that to manage our risks so we can remain solvent and ideally profitable. But they will begin to be competing over a shrinking map of insurable communities. And I think that's going to apply a ton of pressure to their models. And then, one kind of chilling question is, in the United States, in order to get a 30-year mortgage, you have to have home insurance. Homeowners then prove to the bank that on the moment that they buy the property that they have home insurance. But what happens when their home insurer drops them? So now you have a bank possibly holding a mortgage on a property that's no longer insured. What are the ramifications for the homeowner trying to sell? For the bank that needs that mortgage to be able to be sold to someone else. And then that's against a backdrop of a state that might not have the resources to respond to a natural disaster.
Thank you, Mika. There is a question about biodiversity, which I think I'm going to give it to Agnieszka. So it's should biodiversity risks be considered as part of the climate transition risks or a different type of risk? And also, can investors and market, largely speaking, consider it and from when? This is an interesting question, especially because, so much research is coming out on biodiversity risks, but it's also being, discussed how some policies, climate-related, that aim at the climate change mitigation policies might be destructive for biodiversity and vice versa. So we're still trying to figure out, how to deal with both of them at the same time.
Yeah, so I'm not sure if I'm able to answer that entire question of how to solve, but I will, on the specific biodiversity integration into the prudential frameworks, and that also links back to the previous question on, are these separate risks, are these drivers of existing prudential categories? I think it's really important to kind of recognize that some of the especially sustainability disclosures that treat climate and environmental risks are separate, are made for a particular type of stakeholders. But the second we are in the world of prudential regulation, Basel rules, if we are also thinking from the perspective of impact on capital requirement calculation, additional capital requirements, and supervisory powers that may be imposed by prudential supervisors, here we are within the remit of more traditional risk categories, and therefore EU framework has also, despite having a separate definition of environmental, social, and governance risks, very much integrated the assessment of climate and environmental risk drivers as drivers of quote unquote traditional risk categories, credit, market, and operational. And I think this also kind of helps us understand kind of to what extent banks should already be looking at the impact of biodiversity risks and environmental risks on the creditworthiness of their clients over different time horizons, or kind of impact on biodiversity and environmental risks on market risk, especially related to kind of commodity movements, price movements, for example. So this to say that under the EU framework, we have clarified that both climate and environmental risks should be considered by supervisors in the context of existing prudential assessments and the context of existing prudential categories as well. But we are experimenting a little bit with the different types of tools that are helping us identify and manage these risks, either transition plans, climate change related stress tests. And we are actually doing now a study here at Grantham looking at banks' disclosures and how they are incorporating environmental and biodiversity concerns already and communicating this through their disclosures. And of course, especially those banks, for example, that deal a lot with either emerging markets or are specialized with, for example, in the agricultural sector. You can imagine cover quite a bit when it comes to their biodiversity and environmental risks. There is also
Very
a question from Maria Nieto, I think, just
Yes,
about.
exactly. I was about to ask this one, but it's addressed to Mika, and basically it's Maria says that the US has eliminated its objective to net zero 2050, as well as the economic regulation to reach that objective. The US is not subject to climate transition risks. So it's only subject to physical risk. Hence, banks' reporting requirements would only be necessary for physical risks. Why then require reporting on transition risks?
Yeah, I started to answer this in the chat because I couldn't resist, but I'll recap my answer. So first, yes, you're right that at the federal policy level, we don't currently have federal policy driving transition risk. Although I will note that we do have state policies that contribute to transition risk, whether it's in the form of phasing out internal combustion engines, phasing out gas-powered lawn equipment, or investing heavily in clean energy technologies, which fundamentally change the cost and mixture of energy in our system that I think poses risks for oil and gas assets. But in addition to that, I mean, I think there are many other reasons why financial regulators think that US institutions and companies are still exposed to transition risk. And that can stem from changes in consumer preferences, technological advances, global market trends, and exposure to foreign regulatory requirements. I mean, I think one example that we cited in the SEC disclosure rule was the carbon border adjustment mechanism, where you are maybe a US producer that's exporting into the EU and need to not only disclose the carbon embedded in your products, but will have to pay a tax for that. So I think transition risks come from many different sources, not just federal policy, but also our federal policy changes rapidly. And so, yes, we're in a moment right now where I think it's hard to imagine a credible transition law or regulation, but that could change, in the next administration.
Thank you very much. I think we are just about the right time to end this webinar. Thank you very much, Agnieszka. Thank you very much, Mika, for very interesting presentations and also very interesting Q&A. Thank you also the audience for joining us today. Our next webinar is next Monday, actually. And it's another interesting subject that has to do how to use AI to help with policy making and academic research related to climate. So if you need to register, you can register on our website. Many thanks again.
Thank you.
Bye-bye.
Thank you so much. Bye.